Thank you very much for coming out, and welcome to the New School. I'm Rachel Dawn Fudim-Davis, and I'm a co-founder and co-president of Net Impact New School University, NINSU, as we call ourselves. For those of you who are not aware, Net Impact is a global organization comprised of students and professionals seeking to change the world through business. What makes the New Schools chapter so unique is our diversity of program focus. We have students, faculty, and practitioners in the areas of economics, media, music, design, drama, management policy, and more. Social innovation has a presence here, and our efforts through Net Impact and the growing social entrepreneurship curricula at the New School aim to harness our talents and apply them to industries both nationally and internationally. Through these initiatives, we were recently selected to partake in the Ashoka Changemaker Campus Consortium, through which students are developing the skills to assist the university in capitalizing on its rich pool of expertise. Our micro case study of the New School University is applicable to real life, where too often we operate in silos, and more often than not, the result is stifled collaborative innovation. The issues and topics Net Impact offers stimulate this necessary innovation and investment. For New School students, graduate and undergraduate, who are not yet involved with Net Impact, I strongly urge you to learn how you can tap into the network by visiting our website, netimpactnsu@blogspot.com, and emailing us at netimpactnsu@gmail.com. And if anyone is more interested in learning about NINSU, you can shortly learn some more information from Sean, who will be sitting at the drink table over there. We're only as good as the talents we're empowering, and I know our school has vast untapped talent. Student chapters of Net Impact are not only breaking down silos and changing systems at our schools, but we're reaching out so we may offer our perspectives, insights, and questions to professionals through events like this, as well as viable business collaborations. We are deeply moved to make the world more balanced and more equitable. To that end, students and professionals have a great deal to learn from each other, and while we students may have a modest disposable income, we recognize the value in responsibly investing our dollars collectively, and there's great power in numbers. I want to ask by a show of hands, how many people have heard about this Let's Learn About Coal coloring book, the coal industry's most recent effort to propagandize clean coal through exploiting a black Labrador, apparently, as its spokes animal figure? Anyone? For those of you who haven't, I'd like to share that the word scramble in said coloring book, which I learned about from the Rachel Maddow Show, is then coal is cheaper, other fuels. This is about money and who stands to lose it. Lobbyists working on behalf of dirty energies are poised to benefit from gutted climate legislation, and the bills in both houses are already extremely weak in terms of driving the cost of renewables down and the cost of coal up. This is old news, right? And I'll be 27 on Saturday, I'm saying this. Some of the same firms working to stifle a treaty out of Copenhagen next month, like Bonner and Associates, worked to shut down negotiations leading up to the Kyoto Protocol. As I'm sure most of you know, last Friday, Republicans on the Environment and Public Works Committee refused to vote on the Clean Energy Jobs America Power Act, the Senate version of the American Clean Energy and Security Act. Ours is an industrialized country, thirsty for leaders to act on progressive and sustainable energy policies. President Obama. So regardless of what the US president and Congress does or doesn't do, we have felt and continue to feel the urgency, the duty to act prior to, during, and after Copenhagen. It is clear to us that we must invest responsibly if we have any shot at recovering our economy, building durable infrastructure, and decreasing our unemployment rate. Regarding economic recovery, yesterday's New York Times editorialized, quote, "At a recent meeting at the White House to discuss job creation, President Obama said that, quote, bold, innovative action, unquote, would be needed from the administration, Congress, and the private sector to undo the devastation in the labor market. There were good ideas floated at the White House meeting, including bolstered federal support for efforts to retrofit and weatherize homes and public buildings, to issue bonds and help finance big construction projects. It goes on to conclude, we know more stimulus spending and government programs are a fraught topic, but they are exactly what the country needs. It may be the only way to prevent a renewed downturn and the only way to create the jobs needed to put Americans back at work. Those are the essential and missing ingredients of a sustained recovery. We cannot afford to wait for President Obama nor his Congress to act on our behalf versus that of Big Coal or Goldman Sachs. We must be prepared to take the matter into our own hands. I very much look forward to our conversation tonight. At this time, I'd like to introduce our panel. First up, we have Kerry Krasinski. Cary co-edited and wrote the book Sustainable Investing, The Art of Long-Term Performance with Nick Robbins of HSBC and other leading industry experts. A follow-up paper has just been published and is available at the UN-PRI Academic Network's website. Cary is a representative for Trucost in North America, where the world's largest database of carbon emissions and other environmental impacts are maintained as well as generated by the world's largest companies. This quantitative data is used by leading global institutions such as Deutsche Bank, UBS, and Vanguard to manage carbon risk, as well as public companies, cities, universities, and asset owners looking to understand and manage their environmental footprint. He is teaching a course this fall at Columbia University on sustainability and investing. Cary was a member of Capital Bridge's Operations Committee and provided leadership on data and analytics. Cary sold and successfully maintained many of the company's largest banking and corporate relationships. He is a member of the 70-person expert group that created the United Nations Principles for Responsible Investment, PRI. Originally, Cary worked in collaboration with TrueCost on their eventual award-winning 2006 UK Trust Carbon Footprint Study, as well as the IFC-sponsored Carbon Counts Asia 2007 report, the latter being issued at the December 2007 UN Bali meetings. He has worked with CNBC, The Wall Street Journal, and numerous other global publishing entities on environmental subject matters and acted as a leading interpreter of equity ownership for non-governmental organizations and the media. Cary is a frequent blogger at greenbiz.com. Cary built and managed the world's first global equity ownership database for technometrics and provided related strategic advice to CityWatch and others with international ambitions. Next, we have Michael Lent, who is a financial advisor with Veris Wealth Partners, LLC. He also serves as Veris's Chief Investment Officer. Veris Wealth Partners is an independent wealth management firm founded by 5 partners who share a deep conviction in the interdependence of values and wealth. Veris believes managing that interdependence with knowledge and wisdom delivers benefits for individuals, companies, and society. Prior to Veris, Michael was the manager of the New York office of Progressive Asset Management for 13 years. He is a certified investment management analyst and has held registered representative Series 7 and registered principal Series 24 licenses. Michael specializes in financial consulting for individuals, foundations, and nonprofit organizations. He is a trustee of the Edward W. Hazen Foundation, a private foundation established in 1925, which seeks to assist young people, particularly minorities and those disadvantaged by poverty, to achieve their full potential as individuals and as active participants in a democratic society. He also serves on the board of directors of Lotus Music and Dance, a New York City organization that promotes traditional ethnic dance forms. Michael is a member of the Social Venture Network and the Investment Management Consultant Association. He is a runner and appreciates the balance that comes from his yoga practice and Alexander table work. I practice hatha yoga. I'm interested in Alexander table. Jerome Tagger, finally. As Chief Operating Officer For the UN Principles for Responsible Investing since 2006, Jerome is in charge of overseeing operations, signatory relations, and recruitment. Previously, he was head of research at EuroSIF, the European Social Investment Forum, where he led the first comprehensive European surveys of SRI markets, supervised the publication of investor toolkits on responsible investment and active ownership, and piloted work on transparency guidelines. Jerome has prior experience in the life insurance sector at BNP Paribas Group. He was also on board one of the first corporate socially responsible supply chain assessments in the non-food retail sector in France and Promodes in 1999 to 2000. Jerome is a graduate of ESSEC Graduate School of Business, France. So as someone with a modest bachelor's degree in economics, I am proud to announce this panel. You may begin.
Okay, so one is going to call up the presentation. There we go. Okay. Thank you so much for having us, and thanks for coming to all of you. So, from beginning, here we go. So, yes, Sustainable Investing, The Art of Long-Term Performance is our book. If anyone has any questions about that afterwards, just let us know. How's that? Is that better? Okay, great. So why are we talking about this? Well, the science of climate change basically is that we need to reduce greenhouse gases by a certain amount in a short period of time in order to avoid the devastation that might occur from rapid climate change. And 2 degrees centigrade is an acceptable limit that the scientists tell us. I'm no scientist, but if the negotiations at Copenhagen don't bring us great change, then we're in for some great change. And of course, if the negotiations in Copenhagen do bring about great change, that's going to be great change of another kind. So the bottom line is that we are in for a period of great change. Business as usual is not possible. So that's why we talk about sustainable investing, which is an investment philosophy that explicitly considers future environmental and social trends in financial decision-making in order to provide the best risk-adjusted and opportunity-directed, Steve, you're out there somewhere, you wrote this, results for investors. By anticipating these trends ahead of the market, sustainable investing seeks to identify predictable surprises that can help protect and enhance shareholder value over the long term. Our book basically was the case for why one should invest in a sustainable manner, looked at opportunities, risks, trends, and was a global perspective. So we had chapters contributed from across the globe. That redefinition of sustainable investing that we just saw was presented in a paper that Steve helped us write, Nick Robbins and myself. It was presented in Ottawa at the UNPRI academic conference. That's the website. I would strongly recommend you go and not only look at that paper, but also the excellent papers presented by Watson Wyatt, Jim Hawley, and Steve Leidenberg. The Watson Wyatt paper we'll refer to in a second. It was a really rewarding event. Thanks again to the PRI folks for having us. Also, I will be teaching a course at Columbia very shortly at night, and the idea there will be to build a most sustainable portfolio interactively with the students. I actually expect them to teach me as much as I might be able to teach them, and I'm really looking forward to that. It starts next week. And so what are we talking about? We actually, first of all, reject the term socially responsible investing as too broad. What is SRI? It's a catch-all phrase. We see 11 different actual practices, and we go into great length in the book about that. There's actually very different things. There's funds with a religious mandate. There's funds that look at alternative energy. These are very different things, and they actually behave differently, and they perform differently. So it's very important to look at these in a granular fashion. And again, that Watson Wyatt paper, we think, did a really nice job on delineating sustainable, which is value-based investing, from responsible, which is values-based investing. They're very different things. But in general, there's still a great confusion out there about what these things mean, and so terminology clarification remains a major barrier. In the book, we also looked at the performance of this strategy, sustainable investing, looking for opportunities, not only opportunities being created by climate change, but also the opportunity to find the risks. So we looked at the 1, 3, and 5 years leading up to when we completed the book at the end of 2007. We actually found that these strategies were already outperforming the mainstream. We once again looked at this for the paper and found that this was still true through the end of 2008, as well as in the first half of 2009. So the takeaway is that sustainable investing was outperforming before the crisis, through the crisis, and after the crisis. Another way of thinking about sustainability might be this sort of a framework. First of all, sustainability is a risk factor. And so if you assume all companies are perfect, any of environment, social, governance, even mainstream financial, that's the F, or Q, quality of management, become ways that you subtract away from the perfect investment quality of a company and could lead to zero, a non-investable company. So these are all actually separate things, and any of them can bring a company to a point where they're not an attractive investment. So for example, General Motors had a failed business model in June 2008 when the company was trading for $16 to $18 a share. Going short on GM may have been the best investment that your money could buy. That's mainstream financial. It's also an indication of a company that was not sustainable. These are all equally valid concepts. And so a little bit about Trucost, the company I help represent here in the US. We do maintain the most comprehensive database in the world of the environmental impacts of public companies. We've looked at over 4,500 global companies. We look at everything from 9 greenhouse gases to water abstraction to a litany of waste and pollution issues such as acid rain precursors. We were formed in the year 2000. It was too soon. People just weren't interested, especially the corporates we were trying to serve. And now we see interest from every constituency you can imagine, universities, public companies, private companies, investors, and we're also thought leaders on environmental issues. If you just go to truecost.com and register, years of our public research is freely available. You're seeing some examples at the bottom of this page, and I'll go through some more examples now. So when you look at our data in detail, you see the 9 greenhouse gases we track, both in absolute and CO2 equivalent terms. And in the lower left, you're seeing some of the more macro metrics that one can create when you combine greenhouse gas damage costs to annual revenue or EBITDA for a measure of profit risk. We'll talk a bit more about that in a second. When we look at a company, we're looking at scopes 1, 2, and 3. Scope 1 is direct operations, scope 2 is purchased electricity, and scope 3 is the supply chain. So that's why when you think of a company like Walmart, they have a huge supply chain. That's why they're looking at this issue. They actually see it as a way of making money. And this is actually Air France, who a few years ago had over-disclosed by a factor of 1,000 that their emissions, and we had to correct them and say, no, your emissions are not the entirety of Europe. So they said, yes, thank you very much. And we had another case of that last week with the largest utility in Europe. So in general, we're also information auditors, and it's very important that the information is correct, not just disclosed. Our methodology is one that where in the absence of that reliable public disclosure, we deploy an econometric input-output model. So we have consistent data. All of those environmental impacts we track, over 750, we have a complete database. It's not full of holes. And we have up to 7 years of history on the companies we track. So what does this mean? So for the companies that have the most potential pressure on them from a carbon standpoint, if you look at the potential price on carbon, both short and long term, this could have a major impact on EBITDA. These are some of the largest emitters in Europe specifically, especially, and also American Electric Power is up there. This was published in our July 2009 UK Equity Fund report, again available at our website, and you can see when you move from a short-term price on carbon to a long-term price on carbon, EBITDA gets seriously impacted. This becomes extremely important for investors to look at. Again, another way of looking at this is EBITDA before carbon and after carbon, and you can see the dramatic difference that makes. Some business models completely go out the window, perhaps coal being one of them. And so these things become very critical for investors, and hence our focus on that. Another thing we've done over the past year is look at the impact of these things on U.S. companies and U.S. portfolios. So we did a study called Carbon Counts USA. I have a few copies if anyone's interested. Looked at the relative carbon intensity of U.S. mutual funds. And some of the results were surprising, although SRI funds were certainly the least carbon impacted. There was quite a bit of variation within. How do people actually use this information? So S&P, for example, has something called a carbon efficient index. It's basically a low carbon version of the S&P 500. Keeps the sector weightings, but rewards the more carbon efficient companies. And this is becoming an attractive investment strategy that we have solutions with some of the firms that were earlier mentioned, Deutsche Bank, UBS, and others. We also work with the equivalent in the UK of the EPA, the Environment Agency, who do a comprehensive environmental footprint of their holdings that they have externally mandated and managed, and they look at them over time and watch trends. They also look at their supply chain with us. Because we have this unprecedented database in scope, we can do a very simple but powerful environmental supply chain analysis for any entity, including a university. And so they're sort of heralding best practice. And just so you know, in case you're not aware, there's an executive order out from the White House to all the government agencies here in the United States. They have a very short period of time to demonstrate an understanding of their environmental footprint and what they're going to do about it. So that's a very exciting development as well. We also participated with KLD in the Newsweek Green Rankings, which we were very excited about. Came out during Climate Week in September. It was the first ever legitimate attempt to rank the largest companies in the U.S. from criteria from our environmental impacts. KLD looked at the policy of the companies, and it was a reputational survey. You can see more at newsweek.com/green if you're interested. We were very excited about that. And so I'm going to conclude by spoiling the ending of our book, which, because it's not a thriller, but we started this book as Credit Crunched, and we end it as long-standing financial institutions disappear, having failed either to link reward with responsibility or to appreciate and properly manage systemic risk. The scale of the investment transformation ahead demands a new paradigm. The challenge for sustainable investing is not to become like today's mainstream, but rather to replace it. And then I will ruin the conclusion of our paper, which went on to say that there's, and this is a quote from Keynes, there's no reason why we should not feel ourselves to be bold, to be open, to experiment, to take action, to try the possibilities of things. And over against us standing in the way, there is nothing but a few old gentlemen tightly buttoned up in their frock coats who only need to be treated with a little friendly disrespect and bowled over like 9 pins. Quite likely they will enjoy it themselves. Thank you very much.
Thank you very much to Net Impact for inviting me. I do not have a PowerPoint. I am going old school at the new school, and I have a handout. I am in the business of being what's known as a fiduciary. And investing individual clients, foundations, endowments, institutional investors' assets. And so the approach I'm going to take here tonight is a very pragmatic one. I'm not going to get into the debate about sustainable versus socially responsible investing. I am a member of the Social Investment Forum, and I am a member of the board of directors of the Social Investment Forum, and I see Joanne Dowdell in the back, who's also a member of the forum. And we believe that the concept of social investing, environmental, social governance factors, sustainable investing is part of a broad effort to build a more sustainable and just economic system globally. We believe it's all part of the same effort. And we integrate in our thinking the way that the environment is approached from an investment standpoint with other aspects such as social and governance factors. And we think that all of these together, that as Kerry's saying, very quality management of companies, investors that are thoughtful, are figuring out ways to really think forward in the future and where this planet is going, both from an environmental and economic and social standpoint. And we think it's actually an indicator of good corporate practices and good investment practices in general to be looking at these in an integrated fashion. But I just wanted to touch upon how, first of all, how this industry has changed. And when I first got involved, it was 1993. And those of us that were practitioners, and Steve Viederman was one of the early practitioners in the foundation world, is in the room, we're really starting out with a very, if you will, more boutique and a small number of clients that were really interested in this area. And there may be at that time were a couple $100 billion in assets that were either socially screened or people had been involved in proxy fights, which I'm going to explain in a minute, or that had directly invested their money in community investments in low-income communities. And since that time, the Social Investment Forum does a study every couple of years. And a couple of years ago, this was before last year's crash, but there were over $2 trillion in assets in the United States, or 9% of investable assets, that were invested in some way, shape, or form where investors were using some form of the methodologies of either shareholder activism, integrating environmental, social, and governance factors in portfolios, or social screening. So we've seen a huge, huge change. And I would say where we've seen this in particular is, one, in terms of institutional assets that are now invested in, again, in more socially conscious portfolios, but particularly sustainable portfolios, and addressing the issue of climate change. And secondly, direct investments that are being done in these areas, and I'm going to talk about that in a second. So first off, in terms of the coalitions, there's some key groups. Ceres, and Ceres was a set of principles that were adopted in 1989, essentially to get corporations to sign on to take a series of principles that would be part of their corporate practices around environmental issues and climate change. Ceres helped found a coalition called the Investor Network on Climate Risk, which is essentially a network of, I think it's somewhere now around $2 trillion in assets. And again, investors that are taking these principles on and integrating them into investment portfolios. There's been a significant effort one of the difficulties is getting disclosure and getting corporations to disclose their environmental, social, and governance factors. And the Global Reporting Initiative, which was partly initiated by Ceres, is one effort to do that. And the Social Investment Forum has a proposal to the SEC for mandatory filing. So every publicly traded company would be essentially required on an annual basis to report on environmental, social, and governance factors using the Global Reporting Initiative guidelines as a mechanism to report that. So getting information, as Kerry's saying, is one of the key things. We recently won a significant victory at the SEC, the first one I think that I can remember, which was two Tuesdays ago, where for the first time the SEC ruled that companies cannot exclude shareholder resolutions of a social and environmental nature using the argument that it's part of ordinary business, and that when investors are asking corporations to evaluate the financial risk being created by their by their environmental policies, that normally in the past the SEC has allowed corporations to exclude that as part of ordinary business. Well, the SEC ruled a week and a half ago that resolutions cannot be excluded based on the financial risk created by the environmental impacts of those corporations. And that's a major victory in terms of getting more resolutions put forward on the proxy process with corporations. So this whole area of shareholder activism, coalitions that have been created by both corporations and by investors, in putting pressure on corporations, getting them to report and actually getting them to change their behavior has been a key focus of many of us in the industry over the last 15, 20 years. The second area, social screening, there have been indices created, the Dow Jones Sustainability Index, that show the outperformance of companies that rank at the top of a set of sustainability criteria versus those companies that rank at the bottom. I don't have the slide. If you go to Sustainable Asset Management website, they have a study that's excellent on that. And so investors have been using social screening and social criteria in their investment processes towards outperformance. And there's evidence that's been gathered over the years that there is some evidence that this is the case, that at a minimum it has a neutral impact on performance. And the last area that's part of this, my one slide, my one handout, is that there are a number of ways that you can actually direct investments in both public and private equity. There are, as people probably are aware, a number of green funds, mutual funds that have been dedicated, exchange-traded funds that have been dedicated in the area of environmental investing and green investing in general, Winslow Green Growth. There's a whole series of exchange-traded funds that are available. And so there are many, many more choices. I mean, when I began and started out as an advisor, I mean, we only had a very small handful of options for clients. And now there's literally dozens of options available in terms of really directed investments in the area of environmental and green investing in general. So you do have, there are options out there, and they can be integrated into portfolios. In the area of private equity and venture, just one fact that this year, in terms of venture investing, the area of clean technology will actually, the amount of money invested through venture funds in clean technology will exceed every other sector, meaning compared to technology, healthcare, and other sectors, for this year for the first time. And there's literally been billions of dollars invested in this area in terms of direct private equity. And green real estate is obviously something that's up and coming, and there are just a few dedicated green real estate funds that are available. And last but not least, and this is all again listed on this sheet, in the area of community investing, meaning directed investments, there's the Green for All fund that is basically enabling, it's a loan fund, below market rate return investment to enable the retrofitting of buildings and using the training of low-income people into the whole green economy as the mechanism and way of doing that. So you have a whole development in an area of below-market investment vehicles for institutional investors, again, that have very directed impact in terms of the area of green investing. So when you look at this as a whole as an investor, as I said, over the last 20 years, the number of choices that you have in the approach towards the different asset classes has really grown dramatically. The amount of assets has grown. The opportunity to have an impact has grown. And I think for any of you who are interested in the field of finance, the jobs that are starting to become more and more available from firms like Veris are also growing. And I think it's, I'll just say one last thing. It's really important for you both as students to demand of your university that these classes are taught and that this is a central part of the curriculum in your school. And secondly, that you do consider careers in this area, because I think this is if you look at all the areas of investing and you compared when we did the study at the Social Investment Forum, the growth, and I'm talking about now not the asset growth in terms of where the markets have gone, but the actual growth in new assets and new opportunities in the area in general of social investing and sustainable investing has grown much more rapidly than any other area of finance. And if I had to predict over the next 5 to 10 years where this area of investing is going, given the necessity in order to have a sustainable economy and have a sustainable environment, that I do believe that this is going to be a tremendous growth area, and you should consider going into it. So thank you very much.
Good evening. Couple of things to start. I guess like to know who of you had heard of the principles for responsible investment before tonight? All right. And who's starving and really thinking they want to be outside having a burger or something? Yeah. Well, you guys are very polite. Thanks for inviting me. And I'm sorry because I have a cold and I'm also French, so neither really help in talking publicly. But in fact, my colleague Lauren claims that the biggest impediment to recruitment of new signatories in America is that every time I talk to an investor, they just have to laugh on the phone, they're like chuckling. So the principles for responsible investment is, note the bold use of grammar, 2 things. It's a set of high-level principles aimed at helping institutional investors, quoting from memory, integrate environmental, social, and governance issues into mainstream investment and ownership practices. and I can explain that later. And it's also a network of investors, of signatory institutions who have committed to these principles and who, on a good day, collaborate to implement them. So far so good. Have I said anything funny? No? Okay, you're still very polite. The principles were launched in 2006 at the New York Stock Exchange by the former UN Secretary General Kofi Annan. They were created as the output of a process that involved pension funds, number of large pension funds, including CalPERS or the New York City Employee Retirement System here in New York, and an expert group of which Cary was a kind member. We loved your contribution, Cary. And we speak at events every week, so we're sort of teasing each other. The starting point was how can you really think about sustainability without having a holistic take on this? You've got the SRI funds market, you've got corporate social responsibility, you've got all these people crying about climate change, you've got the corporate governance movement, you've got all the people that are full on about shareholders' rights and all that. And really what we need is a framework that enables all these people to in some ways come together and provide a sensible take on what responsible investment can mean for institutional investors. Do you all know what an institutional investor is? Yeah. Now I'm going to say two dirty words, and if you don't know them, tell me. Fiduciary duty. That's all good. You guys learn a lot of stuff at school these days. We never got so far. The trouble with institutional investors is that they have fiduciary duty, and they also have fund managers. That's another issue. But primarily, whenever we talk to investors and say, "Well, you guys should do responsible investment," they said, "Oh, I can't. I have fiduciary duty." It's like, "No, sorry, I can't go out on a date. I have a class." So it was kind of the same spirit. In bringing the pension funds to the table of the discussion, what we enabled is to develop principles that worked in the context of fiduciary duty. This was the whole point. The principles, if you had a chance to look at them, are interesting because they say a few things. So they say fiduciary duty. They say that they are voluntary and they can implement them over time. This is usually the question that Cary comes back with. Yeah, you bring it up? Okay. What's interesting is that their processes, not values. So the principles don't tell you, you as an investor must care about climate change and you must care about corruption and you must care about, even though that's what I deep down believe, but we can't say that publicly. So the principles say, rather smartly, if you think that these issues could have an impact on, your investments and on the performance of your investments over the long term, then here's 6 different ways in which you can address them. The first way is through analysis, investment analysis. That's the first principle. So if a portfolio manager, you get all these, data on the issuers, the companies that you want to invest in. Taking just public equity as an example. Then, you might want to integrate ESG data that you could source from Cary of one of his many competitors to, help make decisions. You could look at it also in other asset classes, because investors don't just invest in stock, they'll invest in property, infrastructure, lots of other things. So there you also have a lot of tangible and very visible environmental, social issues that are interesting to look at. The second principle is about active ownership. It's about what are the rights and responsibilities that come with being the part owner of a company. If you're a shareholder, you're a part owner in a company, and so actually you have the rights. The rights differ depending on what country you're in and what your stake is, but you can basically, you have a certain claim to, go to AGMs and raise your hand and say, hey guys, what's your carbon footprint and all these things. The third principle, and the first two principles are the more active ones, but the other ones are really important. The third principle is about disclosure from issuers, or requesting disclosure from issuers. So it's great to do analysis, it's great to be an engaged investor, an active owner, but if you don't have data, about the company's ESG performance, then you're somewhat limited in what you can do. So the third principle requires, and companies are usually a pretty good source, not always perfect, but a pretty good source about ESG data. So the idea is to go out to them and ask for it. The fourth principle is about aligning the market incentives with your investment objectives in a nutshell. As an investor, if you want to be a responsible investor, if you're a long-term investor, you have certain advantages in ensuring that all the people in your supply chain, the fund managers, the sales side, the researchers, and on, do things that foster this long-term thinking. So it could be encouraging long-term research, it could be structuring mandates around long-term management, all sorts of things. The fifth principle encourages collaboration among investors. This is a truly important point. No single investor in the world, and including in our network of signatories, is actually large enough, is powerful enough to address a lot of the issues that we talk about. Take climate change. I mean, you see how things are going through legislation here in Congress and so on, or not going, or maybe going, and come back at Christmas. We'll see how the show ended. Imagine you're a pension fund somewhere in the U.S. with $50 billion assets under management, and you think, hey, I'm going to solve climate change. Well, I'm going to tell you something. If you do it alone, you're screwed. But if you start working with other investors and start collectively sending a message that the investment community is concerned about the impact of climate change and remediation and mitigation and all these fancy words, then you're more likely to have an impact. And that's a really important principle. And collaboration is something, I guess, we talk about INCR and others, but that's really critical to responsible investment. The sixth and last principle is about transparency. It's actually about transparency of the investors, and the premise is that if you're responsible investors, and if you commit to the principles, then it's kind of good that you can have some disclosure about what you do, and then your clients and beneficiaries are actually very likely to want to know what you're doing, because they might think that you're going off on a tangent that they might not be ready to follow. So generally more disclosure is good. So that's just the principles. We haven't touched them. There's all sorts of possible actions underneath them, but they're not really, in my mind, important. The principles are meant to guide policy and implementation. So investors have investment policies. They're rather boring documents, but they're kind of useful to actually implement the policies and invest. As an institution, I said the PRI is two things, and the other thing that it is a network of investors. We have to date about 630 financial institutions and service partners that are signatories globally. They collectively manage $21.7 trillion US of assets. I'm not going to go into the technicalities of what the number means. What I would say is that it's not an achievement, it's a potential. So it's not 21 trillion that are invested in wind farms. It's investors that have responsibilities for 21 trillion that are thinking, gee, I should start thinking about this stuff. That's essentially it, with a range of more or less active investors within that group. I don't know how am I doing on time, but I'll say a couple of things about what we do as a group, as the PRI, as the Secretariat for the investors. Well, we have a big tool that we call the Engagement Clearinghouse, and it speaks to Principle 5, and I talked about the importance of collaboration earlier. One of the things that we do is we facilitate collaboration among investors. So we don't drive an agenda specifically or issues, but investors who are part of our network, typically, they typically, come up on this forum, which is essentially intranet driven. They'll say, "Hi, I'm pension fund so and so from Canada, and I'm in a dialogue with companies in the mining sector about what can they be in dialogue about?" Lots of things. Mining. So about corruption or something. And these are the companies I'm in dialogue with who like to talk to them. Who like to join the dialogue, who like to co-sign the letters, who like to vote alongside my funds at the upcoming general meeting. We facilitate that. So what facilitating means is telling all our other investors in the network, say, "Hey, look, this thing is happening, and we think it's interesting. It could be interesting to you." We organize webinars. Webinars are, and think of our network as a truly global network. We're in 37 countries. We have people everywhere. I mean, my office is in London. I talk to them. They usually, I'm still in bed and they're already at work. And then when I actually get to work, they're already in bed, that kind of stuff. It's a truly global network. And in that sense, technology is helping us a lot to make it a global meeting place. So we have about one webinar a week, and then investors come and listen in and listen to experts that talk about the topic of the day or the ongoing engagements and all that stuff. And then we facilitate, we co-sign letters, we arrange meetings with the companies, all sorts of things. The second thing we do is we also facilitate collaboration around the development of best practice. So there's lots of existing best practice. You've got people, like my fellow panelists who've been there for, way longer than the PRI. I mean, the PRI is kind of the Mark Wahlberg of, new kid on the block in the responsible investment. But what's really important is there is best practice out there, and sometimes our role is just to facilitate the exchange of that, is to help the practice sort of trickle down to all the other signatories that have questions about how to implement responsible investment. Sometimes we have to develop it. So I'll tell you about a couple of areas that we've worked in. One is private equity. So private equity, for half of America is a boon, and for the other half of America is a really nasty word. But it's an approach to investment. An out-of-market equity approach to investment. There were lots of debates about, job destruction, union busting, lack of transparency, sorts of things, under the impulsion of some of our signatories, we brought together private equity funds and their institutional investors around the table, and we said, well, it would be good if you guys sort of figured this stuff out together and came out with some ideas about what investors can do in private equity to, foster more responsible, sustainable investments. So as a result of the initiation of that work stream, we published a couple of papers that are available on our website alongside many other things. One is a series of case studies about what the KKRs of the world can have done or can do to address ESG issues. The other one is a guide for institutional investors, the so-called limited partners, so they're the pension funds that put their money in private equity funds, about the types of questions that they can ask to the private equity funds about how they manage ESG issues at different stages of the investment process. So that's the beginning of work that we're doing with private equity, and there's going to be more of that. Another area that we're exploring is small funds. Small funds have lots of challenges in the investment place. Some of them is, well, they mostly have no dedicated well, they have no staff, so, let alone dedicated staff to responsible investment issues. They don't have money, so it's much harder for them to secure research or other things. And they don't have the same leverage over their investment managers. If you're a big fund, it's quite easy to talk to a manager and say, well, you do this, this or that, or you don't get my business. If you're a small fund, you have far less leverage. So what we do there is we draw again from best practice for different small funds around the world, how they solve their issues, the challenge of resources. And what we increasingly see also is that addressing the resource challenge is essentially through collaboration. So where we're aiming next in this work stream is to develop tools for our collaboration products, essentially, for small funds. So, you can share staff, you can share proxy voting services, you can share parts of your RFP processes, data collection, so on and so forth. That's the kind of things that we do. We have an academic network. Cary mentioned that. We have a public policy network that's just kicking off, which is essentially about educating policymakers about how the investment space can contribute to some of the sustainability challenges. Yeah, I mean, I could probably go on forever, but all the things we do, I have a big team in London. There's about 20 people now. If you ever go there, make sure to go visit them. Well, thanks for your attention. See you around.
Thank you so much for the introduction into what you're doing. If we could actually, we're going to open up to the question and answer session. If people could line up on this side, if you're interested in asking a question, that would be great. We're actually going to take this microphone. You guys can stay seated, and we'll just pass it along.
Hello.
Also, please state what your affiliation is and then proceed to your question. Thank you.
My name is Frank Morris, and I'm Vice Chairman of New York State Sierra Club, Chairman of Long Island Sierra Club, and I also run Ecologic Advisors, a New York State Registered Investment Advisory. What market incentives could tip the balance of investment toward efficiency and renewable energy and away from the present fossil fuel-dominated infrastructure? And are asset managers promoting these incentives?
That would be you. There are a lot of interesting things going on in the realm of energy efficiency financing. So that's one area where government incentive can spur investment. That would be the first thing that comes to mind.
So as an institution, we don't take position on issues, so these are just personal comments. But I think the first thing is to actually figure out a global framework for carbon solutions, so either cap and trade or tax and redistribution elements that will sort of set a framework for people to actually start looking at the actual cost of carbon and making decisions based on that. And then, yes, I mean, obviously, tax incentives. And also, I think what's interesting, there's different approaches to investment. Sometimes it's it's private. Well, it's capital. It's capital that going through venture capital, private equity, and other things. But a lot of the development of new technology, and particularly in Europe, is actually done by large corporations who are already active in different technology spaces, and I think they are doing lots of things. And what's interesting is to see that the solutions that they look for is let me say, what they look for as a solution is a means of scaling what they do, and the way they do this is to look for other corporations to work with them. Munich Re, the bigger insurance company, has a big project called Desert Tech, I just heard about this last week. Sorry? Yes. Were they hoping to actually build a big sort of solar and new energy resource there and link it to the grids in North Africa and Europe at a minimal sort of loss of efficiency. The challenge for them is also to find other other corporates, other investors and governments that are interested in getting these projects to scale. So again, collaboration is, I think, the central elements of the solution.
I mean, the other thing is, back to my presentation, you know, if these things are profitable, then the investors will follow, inevitably. It's just a question of time.
Hi, my name is Jim Brown. I'm a forensic accountant that works for Milberg. They're a law firm that represents clients, basically pension funds and other clients that lose money in the stock market as a result of fraud. And so I had a bunch of questions, but I'll just pick one. One is, at least one of you mentioned disclosure and transparency. And I'm wondering what your thoughts are regarding the SEC's ability to police the compliance with that, and also with the companies, whether we have cap and trade or a carbon tax system that gets passed, how the companies will comply with it and be honest and accurate in their reporting.
Well, I'm going to address the first question. I was on a panel last week, 2 weeks ago, on policy issues, and we had a representative, one of the commissioners of the SEC, Commissioner Aguilar's office. From hearing her presentation and hearing in general what's happening at the SEC, there's a couple of key things to note. There's two aspects. One is will, meaning do you have the leadership that believes in regulation? And for those of us, I'm sure people in the room know, until most recently, that leadership hasn't been there at the SEC. If anything, the SEC was being gutted over the period of the Bush administration. So first of all, do you have the leadership there that's willing to really police and regulate? And secondly, do you have the resources? And are there sufficient amount of resources going to follow through and be able to monitor things? And then thirdly, do you have the training? Because, the markets have become very sophisticated and people find all kinds of ways to get around things very quickly. So you have to have a very, really excellent, very high qualified staff, training, follow through, et cetera, in order to be effective. So I think if the will is there, the resources are there, and the training is there, then it could work. You could actually have, you could have real regulation in this country, and actually something being followed. So I think we'll see. I mean, it's not clear yet how things are unfolding. I think there's more will. There's a greater will. I mean, certainly the SEC has been embarrassed by many things now. And there's a greater desire on the part of the chairperson, Mary Shapiro, to actually, do something. But they've got to be resourced and staffed. And so, we'll see what happens over the next couple of years. I'm not.
Sorry. Thank you. That's a very important question you asked. The key factors are what information will be disclosed. So it's essential that the information be relevant and be thought through very carefully. You can just ask for a disclosure, and it could be, how much community investing are you doing? So the questions are very important. And as I presented, the ensuring that the information is accurate is equally important. So for all the great work that the Carbon Disclosure Project does, just last week, the largest utility in Europe came out publicly and said the data was not accurate, and they're not going to change it. They're going to change it next year, not this year. So global, mandatory, auditable disclosure has to be the goal. And the global part is the trick. So you have U.S. companies regulated by the SEC. Well, guess what? The U.S. and China are in some ways one country now. We have our manufacturing done in a different country. So how does the SEC regulate in China? These are very important questions. It's still, I think the answers are still forthcoming.
Yeah, I think the disclosure of what is critical and disclosure to whom And I think it's just important to say that disclosure is a tool and it's not an end. You can have all the disclosure you want if you don't have end users, which are people that, I mean, companies report to the SEC, they have 10Ks, right? That's the word they use. Who's ever read a 10K? Any one of you read a 10K? I got the wrong audience. Usually there's like one person. Who's read a GRI report? Slightly better. Thanks for making my point. I never have read either, and that's not to say that so no one's fatalistic. No one's ever going to read anything. Of course, lots of people read these things, and some of them are gatekeepers or they're professional service providers whose role it is to do this for others. There's also different audiences. We talk about financial markets and the SEC, but disclosure is also interesting to employees and other regulators and so on. But ultimately, you can't take away anything from the notion of responsibility, and the responsibility is with everyone and every institution to do what they need to do with the data that they're given.
I have a much more general question. I'm Carol Sterling. I'm Director of Arts Education for Brooklyn Arts Council. And because I am deeply involved in the New York City public schools and visit hundreds of schools every year, I want to ask a fundamental question. What coordination is underway between your groups and the folks that you work with educators who are updating curriculum, whether it be in social studies, economics, science, technology? I wonder whether the textbooks, the conferences, the professional development for the folks who teach these areas is something that you consider when you think ahead to your outreach.
The short answer for us is we do not. We work, our constituency as investors and so to speak, so our primary focus is to educate investors. What we try to do is to develop some leverage, but it's not at a primary school or high school level, and it would be quite a stretch for us to get there. But what we try to do is to get into financial education, which is MBAs, which is the CFA, and that level of things. I haven't been to school in a while, but my impression is everyone that I talk to that we get involved in these issues and in the scene, well, not everyone, but there's a recurring story of the 40-year-old person that says, you know what, I came home last night and I told my kids, but all we're doing in sustainability and so on, and they knew much more than me. So I'm not close to it, but I'm under the impression that probably there's some kind of progress that's taking place regardless of us, so maybe it's you guys.
No, I mean, not in terms of primary and secondary, but I will say that, you see from the younger generation, certainly the desire, if they do, again, looking at it from an investor standpoint, that they are, when they become adults, that they then decide that they want to change perhaps how the investment strategy is of their families. And we deal with, families and foundations and others, and we're finding that the younger generation tends to have, greater interest in seeing how the money, if they're involved in their family foundation, for example, it's often not just how the charitable contributions are being made by the family foundation, but also how the family foundation's money is being invested. So you'd certainly see that, from the next generation. And I think what you're talking about is very important, but I can't say that, as either part of the Social Investment Forum or Veris have really focused on that aspect.
Thanks for your question. I think yours is the most important question of all. The next generation are the ones who are going to inherit what we've left them, and it's perhaps our job to get there in one piece. And nothing excites me more than meeting engaged students like Atlee McFallon over there. You should all meet him and get to know him. He's great. And that's why I'm looking forward to teaching at Columbia next week. I'm very excited about that. And you've inspired a thought, which is another category of green jobs that one can consider is becoming an educator and adding that to your curriculum. So thanks for your question.
This is really awkwardly placed, so I'm just scoot it over. Hi, I'm Amanda Kaiser. I am a nonprofit management student at Milano and also involved in Net Impact. And as I listen to you guys talk, I think about the pre-crisis economy in the United States and how, this huge boom in investing led to, maybe not led to, but was coincided with a large disparity growing in this country between the rich and the poor. And I'm wondering if you think that socially responsible investing and the things that will come out of that will in any way essentially trickle down to the common man. And we saw in the crisis that it's had a huge impact on Main Street. And do we think that there will be perhaps a positive impact in any real way?
Well, there's been, because the talk was short, there's a whole field of what we call community investing, which involves community development financial institutions, credit unions, community banks in the United States. They did not issue out subprime, lending. They did not do the kind of lending practices to, that inflicted the pain that occurred through this last period. They deserve your deposits very concretely. I mean, they exist. Shore Bank Chicago, the Self-Help Credit Union North Carolina, they're doing tremendous work in working in poor communities in providing mortgages, et cetera. There's the Calvert Foundation Notes, which is an intermediary that invests in other community loan funds around the country. Most of these, not all of them, but most of them are what we'd call below market rate return, meaning you're giving up some return, although after the last couple of years you might be gaining more return. There really is a network of literally hundreds of these institutions. And I think one of the challenges, and I've been encouraging all those that are part of their networks, they're really struggling because they're trying to get, here are banks and credit unions that really deserve, more support at the federal level, and yet look who's getting bailed out here. And you could have a whole model, a different model of banking in the United States. It exists. These institutions exist. And so I think one of my jobs, is encouraging investors to take some portion of their investable assets and placing them with the Calvert Foundation Notes or the community credit unions or community banks. There are many more. I'm just listing a few here. But there are opportunities. They have been growing their assets. There have been more institutional investors. There's the whole area of, I didn't mention, microenterprise around the world. There is money going in these areas. I think the challenge is, somebody asked the question about, the challenge is creating a regulatory system that favors responsible banking and business practices and, creates some real problems and issues for those that do not carry those forward. So you as an investor can make a direct investment in these investments and can make a difference. So there are ways to place your assets, and will they really grow, really expand significantly over the next 5 years? Well, that's one of the roles of Social Investment Forum, which I'm on the board of, is to promote practice of these types of investments. So I think there are some tremendous opportunities.
It's a very deep and loaded question, but again, the simple answer is if it doesn't do that, if it doesn't help the men and women on the street, then what's the point? But you can't. There are things like community investments or whatever, clean tech investments, very targeted things that can have immediate impacts and visible impacts. The rest of it, you can't completely take out the investors of a system. And when I say a system, I don't want to sound like a revolutionary, but you can't take out the investor of a sort of global food chain, which includes companies, which includes individuals, which includes regulators. And what I see us as doing is moving big things a little bit. You know, it's like you've got massive chunks of capital. You've got funds that are 100, 200, 300 billion dollar funds. And if we can get them to nudge a little bit the way they approach investments, then that's a contribution to things that happen when the capital trickles down to more sort of micro things. But to find at any point a way to claim that what we're doing is actually, you know, the fact that the GDP in a country is increased and the poverty levels is diminished and whatnot, that we can directly establish that link, at least with us as an institution, that would be a major challenge. But, you know, if we do, I'll be a happy man.
We need more than a trickle. We need a flood. It's actually time. And this is going to happen one way or the other. And so for the common person, it's a question of just recognizing that. Business as usual is not possible. And so if you're an investor, if you want to outperform, you ought to start paying attention. And there's a lot of people who want business as usual, so the information isn't out there. The community investing that Michael spoke about was the outperforming category of 2008, period. And so there are a lot of ways of going about this. And if you go for business as usual, you'll probably fail just like GM did.
So I just want to react to the trickle and flood thing. Just remember that English is my third language. So I was using trickle down as a metaphoric approach of the direction, not the volume.
Hi, Sean Spears. You guys are talking about regulation, and as we've seen through our global recession, one local regulator, regulation such as the SEC, if it's not done properly, it can lead to world effects, and we all know that global, warming is global. So, what regulator, if any, currently should actually take this on so that we can divert from investing in greenwashing and actually getting into substantial and real investments?
Again, an important question. This one has no answer. It doesn't exist. It's needed.
Then what ideally would you actually suggest? What should?
Well, the closest thing is the United Nations, and that's not really their role. So what Gordon Brown has spoken about is the network of regulators getting together, and the G20, for example, the SEC, the FSA in the UK, the other global regulators cooperating on a set of disclosure principles.
I just want to make a plug. I know the Responsible Endowment Coalition is in the room, and you're all students. And we're talking about invested assets. Endowments are a huge portion of the assets in the United States, huge for institutional investors. So, support the efforts of the Responsible Endowment Coalition, the effort to get the New School Endowment to be, to move in this direction of what we're talking about in terms of sustainable investing. And then if you have contacts on other college campuses, I think it's really critical. I have to say that university endowments, if we had to rank, seriously, if in this field in general, you have individual investors, religious institutions, then sort of trailing the pack, foundations, and then university endowments, I'm looking at Atlee now. Correct me if I'm wrong, near the bottom. And so, really, it's such a huge amount of capital in the United States. And so whatever efforts you can do to support the folks here from REC is really, really critical, and here at the New School in particular.
Some would argue that it might be against your fiduciary duty not to take these things into account at this point. So the lawyers are watching.
Lewis Sterler, Hunter International. You just mentioned the power of university endowments in investing in alternative energy situations. Why isn't it, why aren't more college buildings that are being built covered with photovoltaic cells and sporting wind turbines on their roofs? Where is the trade association for the alternative energy industry promoting to the common public the fact that every building now built should be incorporating these technologies?
Well, one, there are trade associations, that are promoting the retrofitting of buildings, number one, in terms of improving the energy efficiency, and secondly, in terms of photovoltaics on buildings. I mean, there is, again, that I've learned from Atlee, there's a network of universities that have signed on to a set of sustainability principles and to try to get those implemented, campus by campus. I mean, I don't know the status of this particular aspect of it, but I know there was a meeting, right, that was held. I'm looking at Atlee right now. There was a meeting held to discuss these kinds of issues from universities that have signed on to this set of principles. So again, it's a set of principles. So now we need to implement that, and so that takes encouragement from the part of student bodies, faculty, et cetera, to enable that to happen.
And there's a global competition going on between every category of entity, as I've mentioned. That includes universities. Universities compete for the brightest students, the most engaged students. They compete for donors, and they compete in rankings that are done that show how universities are performing in this capacity. So the leading universities are very aware of this, and they are moving in this direction. Certainly Columbia is, and we just need to all get out there and encourage more to do the same.
Okay. Is there anything else you all would like to share with us today? Okay. Well, I suppose this concludes our panel discussion. I just want to give a few thank yous. This event would not have been possible without the hard work and dedication of some key people whom I'd like to thank. The vision of this was brought by Atlee McFillin, a friend of mine. Yes, please. He's also a student of economics here at the New School, an intern at Veris Wealth Partners LLC, and a fan of Net Impact. I had started organizing with Atlee around this ad hoc SRI committee at the New School, which I don't know how many people know about. And then the execution of the event was carried out by Net Impact New School, NINSU, the executive board. These students split their time between work, internship, school, and family. Special thanks also to Zoe Peppenheimer, who is the designer for the event. We are not paid to put events like these together. We have a very limited budget, and we very much appreciate any donations you can offer us on your way out. Sean Seibert, NINSU's treasurer, is sitting behind the table outside with a donation receptacle, actually right over there by the drinks. And the Office of Student Development and Activities was integral to this event's success, thanks namely to Kate Walbert and Lori Singer. And thanks also to Laura Buentello, Fabian Freire, who's taking video right now, our faculty advisors John Clinton and Michelle Kahane. And finally, please join me in thanking our panelists, Jerome, Michael, and Cary. We're so happy you could be here. Thank you so much.